Okay, let's get started. Good morning and welcome to today's Tuesday Market Outlook webinar. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play. And today I'm going to be walking you through my thoughts and analysis on the current market. So before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. So our agenda for today, kicking off with the major equity indices as usual, highlighting some key levels. And, we did have an important data release with the CPI data coming out just a couple of minutes ago. So we'll see how that can impact equities moving forward. From there, moving on to fixed income and commodities, we'll take a look at the sector rotational model, highlighting which sectors are outperforming and underperforming the overall market. We'll take a look at some subsectors of interest that I have for you today, and we'll end today's webinar with some bullish and bearish market observations. So taking a look here at the S&P 500 using the SPY ETF. And first things first, we just had a very important data release for the CPI numbers coming out, and it indicated largely good news. Core CPI came in at 0.4%, which was in line with the forecasted analyst expectations, but a year-on-year decrease for CPI did come out better than expectations here. Let me just see here. It came out at 4%, the year-on-year figure, and the month-on-month figure came out at 0.1%. So both of those estimates actually beat the forecast by 0.1%. It came out lower than expected. So inflation is slowing down at a faster rate than what analysts are expecting it. And this is very positive news for equities. We are seeing equity futures moving up slightly. And, this means that that was a big potential hurdle here for the major indices. Now, for today's CPI report, CPI announcement, I should say, I don't really think it would have had too much of an impact on what the Fed would have done in the next 2 days during the Fed meeting and the interest rate decision that's coming out tomorrow. It was largely known that the Fed it's largely expected for the Fed to pause the hikes for interest rates this month and potentially resume it next month. So this CPI data was more important, not for this month or the next 2-day meeting, but for following meeting in July. And, it does definitely throw a spanner in the works because the Fed was looking at potentially hiking interest rates in July. But with CPI coming out better than expected and another CPI report coming out before the July meeting, we could see, there's definitely an argument to be made for a more dovish outlook here for the Fed. So this is a positive for equities. It means that interest rates could potentially not move as high or higher, and it could either stay neutral for a bit longer or even start to decline, depending on what the Fed does. So overall outlook here for the S&P is definitely bullish. We had some consolidation leading up to this to the CPI data release, followed by a bullish day yesterday. I expect this rally to continue for the S&P 500. We are seeing, the 430 level here actually being broken. There was a minor area of resistance, which price did respect for a few days, just under a week. And we are now seeing that breakout there for the S&P, and another move higher here is definitely on the cards. When it comes to the next key level for the S&P 500 at the SPY ETF, we are looking at 450. That is the next key level here. But you can see that the S&P, by breaking above the 420 level, the 23.6 retracement level, that was a major area of resistance that really proved to be the catalyst for the continuation of this bullish rally that we are seeing. The one thing I will say is that on the daily time frame, we are seeing the 50-period CCI, which is a blue histogram, that is above 200. Now, 200 is what I would consider an overbought condition. And usually when we see momentum reach above 200, there's a higher probability of a reversal lower or a retracement lower. Now, that being said, We have seen in the past equities can remain overbought for an extended period of time. We saw that during the pandemic recovery period, where interest rates were very low. And we saw the NASDAQ and the S&Ps on the weekly time frame stay overbought for quite a few months. But from a risk to reward perspective, the fact that it's broken above a resistance level recently, and even if price is overbought, I still think the risk to reward still favors the upside in the short term, especially now with the CPI data release being out of the way. The next thing to focus on is the Fed meeting, and more importantly, Jerome Powell's speech after the Fed meeting. That's when markets will really decide whether he's a bit more hawkish or dovish. So that would be another high impact event. Okay, moving on to the NASDAQ 100. Price, again, similar to the S&P, where it was stalling at around 350. We saw a limited pullback, but more importantly, price actually recovering from an overbought condition with the 50-period CCI moving below 200. Since then, we have had a bounce higher. So it does look like it's going to be resuming this bullish trend. Price set to open a little bit higher this morning. And it looks like it is heading towards the next key area at 370. Now, daily momentum, not overbought. Weekly momentum is overbought. But weekly momentum can stay overbought for longer than daily momentum. So the fact that we've seen a pullback on daily momentum does indicate that there's a green light for this rally and for continuation higher here for the NASDAQ 100 to revisit the major area of 370. We are definitely seeing a risk-on rally. So we are seeing a lot of rotation into the technology names, the AI names. Obviously, with the AI boom that we've seen over the last month or month and a half, that has definitely helped the NASDAQ 100 outperform the S&P 500. Moving on to IWM, which is the Russell 2000 ETF. So small caps have definitely, been outperforming in the last few days. We saw a long period of consolidation with minor resistance at 180 and price unable to break above that resistance level, but also respecting the 170 level, which is a 50% fib area here on the weekly time frame. But since then, there was a strong breakout with very strong momentum, price approaching nearly 400 on the 50-period CCI, and price immediately rallying to 188, where it is now experiencing a bit of a pullback. So again, respecting another area of resistance and respecting another fib level, which is a 38.2 fib level at 188. Overall, though, my outlook still remains bullish for equities, and I do think it's a matter of time before we'll see the Russell 2000 break above this 188 level. But until we get that breakout, I think your money is probably best spent gaining exposure to large caps as opposed to small caps, because with this fib level, we could see price actually stay and respect this fib level as resistance for quite some time before we get a breakout. And during that time, we could be seeing the S&P and the NASDAQ continuing to rally. This is something we've seen quite often, especially during this consolidation period here for IWM. But if we do get a breakout of 188, that does open the door nicely to 200, which is another resistance area, and 210, which is a 23.6 fib level. So those are the two other key areas to the upside that I am looking at for IWM. Moving on to TLT, the Treasury Bond ETF. So TLT has actually managed to once again stay above this $100 level, which is a new area of support. And price is getting capped here at 104, acting as a minor area of resistance, a previous area of support. So this range for now has become a little bit tighter. And we'll see what happens, how price reacts to the CPI data announcement at the open. But a breakout of 104 would indicate a revisit to 108. However, if we see a breakdown here, if we see a failure to break out, we could see price revisiting this $100 level, which so far has been acting as a very strong area of support. Moving on to the US dollar. So the US dollar with lower inflation, and therefore the Fed potentially taking a more dovish stance, this is most likely going to decline a bit further here over the next couple of days. So, we have major support at 101 on the daily time frame. Price didn't quite reach that upward resistance area at 105.50. And so far, we are seeing bearish price action and loss of momentum. So this could see price decline back down to 102, especially with the fundamentals being somewhat weaker for the dollar due to the fact that CPI inflation is coming out. It came out better than expected. It came out lower than expected. And that means that it gives a green light for the Fed, again, to be a bit more dovish. Moving on to gold. So gold moves inversely to the US dollar. So with the US dollar moving lower, that might provide some support here for gold and potentially a breakout of what has been a minor area of resistance and a previous minor area of support at around 183, just below 185 anyway. The price was set to open a little bit higher this morning before the CPI data announcement. And I do expect, we could see a potential breakout here for gold and a move higher. That being said, with gold, it is also a safe haven asset. And with CPI coming out lower than expected, we could see a lot of volatility here because it could also be a signal for a risk-on rally. And if we do get a risk-on rally, we could see rotation out of gold and into the more riskier, let's say, more growth-driven equities. So I do expect to see a lot of volatility on an intraday basis here for gold. But the key level that we have to keep in mind here is still that 183 area. Moving on to oil. So for oil, we are seeing here that price has definitely declined. And this comes despite the fact that Saudi Arabia is cutting oil production for July. So despite that, we are still seeing oil prices under pressure. This is due to demand concerns in China and the US for the future. And we are seeing now price breaking back below 70, looking like it's heading towards 63. But this is still an area that it's been at quite recently. And we've seen, oil remain quite strong when it has approached these areas into the mid to high 60s. So again, we could see more consolidation and more choppy price action. But overall, the bias is neutral in the short term, neutral to bearish, I would say. The fundamentals do point to a more bearish tone. However, we could see cuts in oil production continuing to act as support here for oil. Moving on to the sector rotation chart, we have 2 sectors in the improving and leading category, and we have 9 in the lagging and weakening category. So we are seeing leadership narrow quite drastically here. But again, we've seen this during the pandemic recovery period where we saw technology in the leading category and maybe potentially discretionary as well, provide leadership for months on end. And major indices continue to move higher. And this is because these 3 sectors, communications included with that, have such a high weighting component within the NASDAQ 100 and the S&P 500 that outperformance in these sectors is enough to drag the entire index higher. So that is what we're currently seeing. We're seeing discretionary actually gaining some momentum, and technology was losing momentum, but over the last week has managed to stall that loss. Communications, on the other hand, strong rotation and losing momentum into the weakening category now, but I wouldn't view this as a bearish sector by any means. Now onto the weakening category, onto the lagging category, I should say. We have financials showing a lot of momentum here and most likely going to be rotating into the improving category. Real estate, materials, I should say. Materials and industrials also showing some momentum, but not as much as financials. And we have energy was initially showing a lot of momentum, but starting to lose out on that as well, moving a bit more to the left. Our defensive sectors and utilities, staples and healthcare, as discussed last week, we are seeing a lot of rotation out of these sectors. This again confirms the fact that we are experiencing a risk-on rally here. Investors are clearly willing to take on additional risk given the market environment. And I expect to see more rotation out of these sectors after today's CPI announcement. So these sectors, these defensive sectors, are definitely ones to avoid for now. I do think that the market sentiment is just a bit too bullish to warrant a bullish position in these sectors where there's outperformance can be found elsewhere. Moving on to some subsector of interest that I have for you today, we have semiconductors, very much at the forefront, very much a headline subsector here due to the AI boom that we've experienced in the last few months. And we are seeing semiconductors after what has been a very strong rally with the 50-period CCI touching 400. Momentum has recovered to just below 200, so not as overbought as it was before. And price did pull back slightly, but again, looking like it's posting another bullish leg. This is also a subsector that is very sensitive to perceived changes in interest rate policy. And the fact that CPI data comes out better than expected, and a more dovish stance is going to be warranted from the Fed, that would likely be a huge tailwind here for semiconductors to push higher with all-time highs at around 160. Moving on to IBB, which was an idea from last week, the biotechnology subsector. Now, this was a bullish idea that I had for you today. I was looking at 126. We were seeing price bounce multiple times from that level, and it was looking like it was potentially going to break out above this 21 and 55-day exponential moving averages. It didn't quite do that immediately. Instead, we had a pullback, but on an intraday level, multiple rejections of 128. Yesterday's price action, quite bullish, breaking above its exponential moving averages. And this could, this could signal a continuation higher here for biotechnology to our 133 first initial target. And also our second target here is 138. So far, biotechnology as a trade idea, doing quite well. I also expect momentum to turn positive quite soon. Looking at DRIV, which is the Autonomous Electric Vehicle ETF, this was a bullish idea that we've had for the last few weeks when price was trading at around 22. The reason this was a bullish idea was because 22 is a major area of support, and that was a bullish thesis for the trade and provided a good risk to reward bullish entry point, because if it broke below 2180, and closed below 2180, that would signal cutting losses, a minimal loss on the trade, whereas on the other side, there was plenty of upward space here for a rally for DRIV. And this was a trade idea that's worked very well for us. I always mentioned that take profit zone was at 25. Price has definitely exceeded that level, and it is also overbought. So I think now would be a good time to take profits. Also, price was set to open a little bit lower on a day when equities were moving a little bit higher. So again, another signal that taking profits might be the best course of action here. But overall, a very very profitable idea. It did rally very quickly to our take profit zone at 25. So moving on to some market observations that I have for you today. And this is a bullish idea on Take-Two Interactive Software. So we've definitely seen a lot of momentum staying positive on the daily time frame for quite some time. And then we had a bit of a spike up in momentum when price gapped up higher from 124 to 140. Since then, we've experienced a bit of a pullback, and that pullback has approached this previous area of resistance, potentially turning support at 132, 133. And we are seeing a bounce higher from that level, with price set to open a little bit higher this morning. On the weekly time frame, you can clearly see we are breaking structure of lower highs, lower lows, with price breaking above this previous swing level at around 135. And again, that is very encouraging for a move for continuation higher, potentially to around that 150 level. That's where I see a short-term take profit zone being. But if we see a break above 150, you're looking at around 180 as the next key area here for Take-Two. Moving on to Fidelity. So Fidelity, a long-term bearish play that we've had. The thesis for this one was, as long as price is below 60, we're good. And this is where, your options strategy comes into play, because if you'd used a debit spread, for example, this would not have been a profitable idea, because price has not moved, has not declined enough to go past the break even, or be a very limited profitable idea. Whereas a credit spread, because it has better exposure to neutral markets, this would be a very profitable idea. And it also still gives you that exposure for a bearish leg as well. So our thesis for Fidelity was bearish due to the fact that this is a long-term bearish trend. Price continued to find resistance at previous areas of support, and and that happened quite recently at the $60 level. So our first take profit zone was at around 50, and our second take profit zone was potentially another leg lower. That being said, we're not quite seeing that on the daily time frame. Price is very much neutral. So this idea, I think, if you did a credit spread, yes, it's profitable, and it's probably time to close it. A debit spread, on the other hand, you're probably near break even. I also think it's time to close it. We're just not seeing the bearish price action that we would like to see. And also, equities are definitely have a more positive, bullish sentiment now. So you'll be betting against the markets. I still believe Fidelity is quite a weak stock, but we're just not seeing enough bearish price action. Moving on to Roku. So Roku was another idea that I had for you last week. This was a bullish idea because price was breaking above this previous area of resistance and previous area of support. So this was a very key area. Price was breaking above it. And for those of you that did take the trade, well done. We from $60, it's now already at $72 a share. Exponential moving averages are crossing over. And our take profit zone was, we looked at 68 as a potential, limited take profit zone, but also I was also looking at 76, which is the previous swing level. So that's where I'm looking at for Roku. And if it breaks above 78, 80, then it's essentially, you're seeing some huge capitulation here after what has been a significant decline here for Roku. And then it will open the door towards the $100 key area. But overall, the thesis here for Roku is definitely bullish. I wouldn't be surprised to see some bearish price action, considering the price did touch an overbought condition though. So keep that in mind. And I think that the best, if you did miss out on this trade, definitely wait for a pullback before looking at another potential bullish move. Taking a look at another idea that I have for you today, and that's AMT, which is American Tower Corporation. So this is a bullish idea, and we're playing off 180 major support. This is a pandemic lows, as well as on the weekly time frame, price forming a double bottom, which provides an excellent risk reward bullish entry point. So far, price is respecting 180. We saw an initial move higher, followed by a bit of a pullback lower. But overall, I view this as a pullback as opposed to a reversal. And therefore, I do think that there's some evidence for continuation higher here for AMT. Next key level is at 210, previous area of support and resistance. And from there, you're looking at around 225, 230 as the secondary take profit zone here for AMT. But the fact that it is respecting this 180 level it is a good enough reason for me to get into this trade, especially when the risk reward is clearly favoring the upside. If it breaks below 180, that's when you'd close out the trade for a limited loss. And with that, that is all I have for you today. Thank you so much for joining me. And I will see you tomorrow for an education session on understanding call and put options. So a basic webinar for beginners mostly. But even if you are more experienced, it's always good to kind of re-hone the basics. So with that, thank you everyone, and I hope you all have a great trading week ahead. Goodbye.